The next portion of the stock pitch competition is the company overview and the statistics at the top of the stock pitch report. So I'm going to walk you through some of the major statistics and what they mean and the company overview. So the company overview is pretty simple. What does a company do? But really what you're looking for here is, how does a company make money? So what is the business model of this company? What products do they sell? And how actually do they make money? You can divide it into a number of categories. You can divide it into different products or different revenue breakdowns. You can also divide it by geography as well. So for example, if you're doing Disney, Disney, as we know, makes movies, but they also have Disneyland, which is a theme park, and they also own television rights and show rights. So they have the Disney Channel, but their biggest profit generator, which many people don't know, is they own ESPN. So they own live sports and sports broadcasting. And so in the company overview, you want to show very clearly where the sales come from of this company and how it makes money. The second portion could be by geography. So Coca-Cola. Many people don't know that the majority of Coca-Cola sales are outside of the United States. So when you're investing in Coca-Cola, you're actually investing more into whether people in India or people in China will drink Coca-Cola rather than people in the United States. And so you want to get a feel for who's buying the product, where they come from, and why they're buying the product. And then we go into the statistics of the company. So this is to give a snapshot to the judges, to whoever will read your stock pitch report, whether it be a potential employer, if you're looking for an internship or a job. Okay, so we start with the market cap, or the market capitalization of a company. And this is very simply the market value of this business, how much the market or investors give the value to the business. This is calculated, very simple, by the price of the share, by the number of shares that are outstanding. So if there's 1,000 shares and they're each at $1, the market value of that company is $1,000. The enterprise value is very similar to the market cap, but it is the market cap plus the debt of the company. So shares times price per share, with the addition of the total debt of the company, short-term debt, long-term debt, subtracted by the cash of that company. So the net debt is what we call it. The next number you'll see is the 52-week range. And this is in the past 52 weeks or in the past year, what is the highest that the stock price has been to and what is the lowest. And so oftentimes we're surprised that the stock trades a lot. So markets are a roller coaster and there's a lot of volatility. And so the 52-week range may be as low as $20 a share, maybe as high as $100 a share. And that's a good snapshot for prospective investors to see, is how much does the stock price swing up and down. The next item is the dividend yield. The dividend yield is basically the dividend per share divided by the stock price per share. So if the stock is $1 per share and the company pays out 5 cents per share, then you're basically making 5 cents for every dollar, and which is a 5% dividend yield. So if I invested in the stock and I put $100, I would get $5 in dividends, and that is expected to continue as you go. And so if you get $5 a year, over 20 years, you're going to make back all your money in dividends that you invested in that company. And then starting in year 21, all of the additional dividends that you received are profit in your pocket. The next statistic is the free cash flow yield. This is the free cash flow per share over the stock price per share. I better pause right here and say, where do all these statistics come from? You can look on Yahoo Finance, you can look on Google Finance, you can look at Zacks Research, you can look at Morningstar. There's lots of sites available on the internet to get the fundamentals of the company so that you can work on these statistics. The key is to know what they mean, because a judge will ask you, well, is a 1% dividend yield good? And you'll have to know what that means. And a 1% yield may be pretty low if I can get, most companies will give me a 3% dividend yield. So it's important to know what these statistics mean as well. The next one, we'll get into the valuation in the statistics. So first you have the PE ratio. And we've learned about this in our lessons, but this is the price per share above the earnings per share of that company. So if a company is priced at $20 a share and it generated $1 per share in earnings, then it would be 20 times PE ratio, or 20 years worth of those earnings is what you're expected before you're totally paid back. And so a 10 times PE ratio, you basically have to wait 10 times or 10 years of those earnings to get that back. Amazon.com may be trading at 100 times PE ratio, which is very high. And so you may say, well, does that mean I have to wait 100 years before I get all my earnings back that I invested in the company? But what is happening on Amazon is that company is growing very fast. And so for high growth companies, and also for really high quality, resilient companies, they'll often trade at higher PE ratios, which you've learned in further lessons. Price to book ratio is the price per share divided by the book value per share, or the equity in the balance sheet per share. The next ratio is an important one, as we know, is the return on equity. So Warren Buffett loves this metric. I love this metric. And this is the return on the equity that you get as a shareholder in that year's earnings. So if you can get a 20% return on equity, that is a fantastic 20% return on that book value per year. And that indicates that this is a great business that can earn high returns on capital. And so the ROE, or the return on equity, is another key statistic. I hope this helps explain the first section, which is the company overview section of the stock pitch presentation.